Hey, Dan Williams here. And yes, that says no cost, question mark. And we are about to see an onslaught of advertising, marketing, and solicitation around no cost refis. Interest rates are starting to come down. Many believe that trend will continue. So, what is a no cost refi? How is it possible? Is it even possible to do that? So, I want to walk you through this really important whether you're a past client of mine, someone that looking to work with me for the first time, or a financial professional. I'm going to pull back the curtain a little bit and let you know how this is possible and give you some of the insights and, more importantly, my philosophy on doing this. So, let's talk about no cost, low cost, whatever we're going to call it, refis. And let's start with the cost. This is a sample closing statement, closing disclosure. And I want to highlight three key areas here. I've labeled them one, two, and three. Number one is this comes under the loan cost on the sheet, but it's origination. Sometimes this exists that the client pays, sometimes it doesn't. So, this is one area to be on the lookout for. Oftentimes, we like to structure it where the client doesn't pay this at all. And I'll get into that in a little more detail. The second area is what I call the true closing cost. You can see a credit report down here under section C, um, mobile notary, recording fees, settlement or closing fee. That's an escrow fee. And up here, some other ones, whether it's processing, credit reports. These are what I call true closing costs because these occur in every transaction. And I'll get into who's paying for it. The next is the other cost. And this is a section I'll dive into more deeply, but I call these prepaids. These are prepayment for taxes, insurance, setting up an impound account. Many of you, probably like me, have an impound account in your mortgage where you pay a prorated amount every month. So twice a year, the servicer, the people you pay your mortgage to, make the payment to the county for property tax, and once a year to your insurance company. Well, you have to fund that. You have to create this new account when you do a refi. So that's cost associated with the transaction. We'll go into that in a little more detail, but those are the three areas. So, focusing on the new impound account. Let's go back to that for 1 minute. The insurance premium, you'll see it down here, $13.97 in this case. If it's due within the next 60 days before closing, or excuse me, after closing, you're going to have to make that payment in advance. That has to be paid. In addition, we're going to create 2 months worth of that prorated amount for insurance to create the new impound account. And then the other one is property taxes, and this is the big one. In this client's situation, it's almost $5,700. So that money that has to come out. Now, when you pay off the old loan, probably 2 to 3 weeks after it is paid off, you're going to get a check in the mail for your existing impound account. And we'll talk about that in the analysis section a little bit later. But it's not going to be 100% what you're funding versus what you're getting back 2 to 3 weeks after closing, but it should be close. So that's a cash inflow, but you have to account for it going out. Okay. This is one other item that we've got to pay attention to. When you do a no cost, low cost refi, we want to target the new loan amount to be as close as possible to the existing payoff. Now, when you pay off your mortgage, it's going to be a little bit more than what shows on your mortgage statement. You pay your mortgage interest in arrears. So your September 1 payment pays for interest in August. So we pay off your mortgage September 10th and you didn't make a payment on September 1. There's 31 days of August and 10 days of September interest that will be added to the payoff. Now, many will advertise a no cost refi, but really it's a no out of pocket. Now, probably 1 out of 10 clients of mine choose to go this route. They're like, I don't want to have anyone pay for anything. I'm going to add it on to my existing loan amount and I'm going to get the lowest rate or the most rebate possible. So I think it works for about 1 out of 10 clients where it's advantageous, but it is the exception, not the rule. So once again, we want to get as close to the existing payoff with the new loan amount. Here's where it starts getting interesting. Rebate. This is the amount of money the lender is going to credit you, give back to you by choosing a rate on their rate sheet. So let's take a look at this, for example. Did you know that this is a snapshot of a scenario that I was looking at earlier? You're familiar with paying points. I'm assuming you've heard that term. The lower you go in rate, the lender wants prepaid interest or points, and 1 point equals 1% of the loan amount. So in this example, 5.125, the lender wanted $4,778. Well, this is not possible doing the no cost refi. We have to go the other way. So let's say the client has a 7% loan. 6.25, the lender is going to credit you $11,537 in this example. There are lower rates available, but the lender is not going to give you as much money. So the key philosophy point number one is I want to take free where free is available. And this is the largest amount of rebate, this $11,000, at a rate that works for the client. Okay. Now, oftentimes there's anomalies on the rate sheet. So what's interesting, this 5.75, way below 6.25, is still giving you almost $8,000. So back to loan amount that you pay off versus the new loan amount, maybe it makes sense to have $507,000, for example, on the new loan to get most of your closing costs paid for. You add the balance to the existing mortgage, but you go down even further in rate. So these are the discussions I have with the client, but this is called the rate sheet. We call this the price of the loan, and it shows how much the lender is charging you or giving you back. You got to get these bigger numbers to make the no cost piece work. Okay? So let's talk about bringing it all together. How do we determine if it's worth it to refi? And I like to say the client has two choices. Choice number one is they don't do anything. They continue to make their payment. They go along in life. They say, Dan, it just doesn't make financial sense to me. It's not worth it. Option B is obviously if you refi. So, how do we compare your current situation versus the new one? Here's where I start. This client had an $850,000 loan, 6.125 was their current rate. Their total payment with taxes and insurance included is $6,730. They've got 1 year paid off, so they've got 29 years left. A common sentiment I hear, common feedback I get is, Dan, I don't want to have 30 years left on a new mortgage. I want to pay this off before 30 years, so I don't want to start over. Completely understand, but go with me here. Client gets a new loan for $850,000. They lower their rate by 0.5%, so their total payment comes down to $63.98. They are saving $332 a month. Man, damn, that's not a big deal. Well, if they continue to make the same payment they're paying now, remember option A I just described is they're going to go along in life and make their current payment. If they do the refi and they make their current payment, the $67.30 over here, they just shave 5 years off of their loan. 60 months they just save by doing nothing different than they're doing today. To me, this answers the question, is it worth it? So let's take a look at the analysis here, a little more detail. One other thing I want to throw out there. Remember, or I did not point this out earlier, if we did a refi and funded in September, you skip October's payment. Remember, you pay interest in arrears. So your first payment due is November 1st. So in this client's situation, I said, okay, they're going to skip that payment. They're going to get about $6,700 of payment relief in October. In addition, they're going to get that impound account. Remember I talked about that impound account? So let's call that another $5,800 or $6,800, excuse me. for a total of $13,500. They're going to put in a mutual fund. I estimated 8%. S&P's almost averaged 10% over the last 30 plus years, but just backed it down a notch. After 30 years, they're going to have $147. But I click this button once we get the payoff when we can. That's how we got to this 5 years. Remember, the client's doing nothing different. They are continuing to make their payment and they invested that cash flow difference. So to me, is this worth it? Yes, absolutely. And we want to take free as often as we can. So let's say we go down to 6.25, a year goes by, we can go down to 5.75. We take free again and we keep analyzing, and does it make sense, current payment versus new payment? So that is the summary on my is it worth it? Key point to take away. Let's compare what they're paying now to the new payment, but they don't make any changes in their household cash flow. That's going to shave years off of their mortgage, even if we only lower it an eighth or a quarter instead of a 0.5%. So this is the analysis that my team and I do. I wanted to share this with you because this is important. Your clients are going to be coming to you, or if you're a past client or someone looking to work with me for the first time, this is the analysis we're going to do to let you know, does it make sense? Is it worth it? And the key is getting towards that low or no cost situation. It is possible. So let me know what questions you have. If you have anyone that you want me to analyze, or if you yourself, you want to take a look at your mortgage, I am happy to do it. I love showing people this, and we'll talk about it and see if it makes sense for you. Everyone is different. Everyone has different pieces that are important to them, and we want to make sure we map out your mortgage strategy, your mortgage refinance strategy with your goals. Thanks. Once again, Dan Williams here. I'm here to help.